Welcome to Financial Education and Business. Get ready, I have another great video for you. This channel is about financial education and business and just trying to be financially free. I hope you enjoyed today's video. Yeah, so one thing that I think is important to know when investing and stuff like that, and looking at a company's balance sheet and income statement and cash flow and stockholders equity, is before you look at all that, you have to decide what is this company is doing to make this world a better place, and is what they're doing or trying to do is going to help people en masse? Is it going to help people, a lot of people, or is just a small segment group of people that have a lot of money or don't have a lot of money? So first understand what the company is providing, and then what segments and what is the group that the company is trying to market to. If it's the whole world, that like Amazon, like Facebook, like Twitter, that is good. But when it's like a Peloton, which it does target a lot of people, but it's so expensive that it's targeting the bougie, rich Silicon Valley group of people. So without further ado, let's get into the balance sheet and understanding it. I hope if you like what this channel provides, the idea and the direction it's going, give me that like, subscribe, give me that thumbs up. Without further ado, let's get into it. So we're gonna look at the balance sheet. The balance sheet is one of the three fundamental financial statements, and is the key to both financial modeling and accounting and such like that. So a simple balance sheet is going to have assets, liabilities, and equity. So your assets will always equal your liabilities and your equity. Your assets are made out of your current assets and your long-term assets. Your total liabilities are your current liabilities and non-current liabilities, and total equity is shares, capital shares, and retained earnings that you have. So your current short-term assets are made out of cash equivalents, accounts receivables, inventory, prepaid, insurance, and cash equivalents, cash available for investments and stuff like that will be all current assets. And current assets are really useful when it comes to making sure the company has enough money to invest for the year, to pay employees, and as well as to invest in themselves, buying equipment and plant and property for long-term investment in operations. Accounts receivable are often just money, as you know, it's money the company hasn't received, but they will receive it in time. But if they don't have money that they're receiving now, then it's going to be hard, because the company is going to have to eventually collect, and if they can't collect, it's going to be a liability, right? Inventory inventory includes amount of raw material, working in progress, finished goods. The company uses this accounting when it's trying to decide what their cost of goods sold is going to be. But inventory, of course, inventory is good to sell, but too much inventory on hand could be a bad thing if nobody's buying your goods, right? So inventory will often decide what your cost of goods sold will be in your income statement. Non-current assets, PP&E, property, plant, equipment, is often your long-term assets, which are just like I said, property, plant, and equipment, and they're considered fixed assets. This line item is noted net of accumulated depreciation. And depreciation is good to understand because when you look at the different kinds of companies, like for example, a storage company called NSA, or a company that is like a wind resorts or Red Rock Resorts, are going to have huge amounts of accumulated depreciation because the kind of company they are, which is they have properties that they are using to make revenue through games, entertainment, and stuff like that. But a company like maybe and maybe Amazon might have it, but like Facebook, Twitter, they might not have as much depreciation, amortization as companies that have to use PP&E for operation. Intangible assets. This line item includes all of the company's intangible fixed assets, which may or may not be identifiable. Identifiable intangible assets include patents, license, and secret formulas. And often this is just, I believe they're amortized. Unidentifiable intangible assets include brand and goodwill. Goodwill, I think, depreciated or amortized. So I think that intangible assets are just often an asset. Like for example, the Nike check sign might have some kind of like patent value, brand value, but in reality it's not like a real asset the company can use. So it's really, it makes understanding the balance sheet a little bit more, it's like fluff, I think. So current liabilities are liabilities that are due within 1 year, in less than 1 year, and they need to be paid in less than 1 year, otherwise they're going to hurt the company. So accounts payable, current debt, notes payable, current portion of long-term debt are all current liabilities that need to be taken care of. Of course, accounts payables are money, maybe it's money the company borrowed, they need to pay suppliers on inventory purchase, or credit purchases on inventory. And then of course long-term debt eventually turns current debt, and some portion of the long-term debt needs to be paid currently, so they need to also cover that, otherwise there are going to be consequences. Non-current debt are just long-term debt that are due for more than 1 year, so they include bonds payable, long-term debt, right? So the bonds payable, this account includes the amortized amount of any debt the company has issued. Long-term debt accounts for the total amount of long-term debt the company has. This account is derived from the debt schedule, which outlines all of the money that the company is going to pay over the life of the debt. So when it comes to debt, I think of course there's different kinds of debt the company can take when they want to raise money to get the company running, or need the money to make big investments, such as maybe with Red Rock Resorts is buying another land to start developing another casino or something like that. So debt and equity are used hand in hand to make financial decisions for a lot of corporations as well as private companies. It's like, for example, you go to the bank, you take debt to buy a car, or you use your own money to buy a car, or you can combine your own money and a little bit of what the bank can give you to buy a car to make investments. So that's how debt and equity is used to make investment on behalf of the company's growth, or for investments in property, plant, equipment, or just assets itself. So shareholder equity, share capital. This is the value of funds that shareholders have invested in the company. When a company is first formed, shareholders would typically put in cash So retained earnings, this is the total amount of net income after all expenses the company has been able to keep since inception, since it became a company. Every period, whether it's quarterly, annually, the company may put out dividends from a net income. Any amount remaining after dividends, preferred dividends, dilutions will be considered retained earnings. And sometimes in net income, there will be money that the company won't be able to keep because there are other native owners, subsidiary owners, part of the company, so they have to distribute some of the net income to alternative owners. So the balance sheet is really a good way to assess a company, to see how their assets and liabilities, how they're leveraging themselves to do well. So there's a quick example of Amazon. There's their assets, there's their liabilities, stockholders' equity. So right here, if you always look, it's going to tell you in millions, meaning this is not 19,000, it's 19,334. So current assets, once again, it breaks it down. Cash, marketable securities, inventory are all, and then it gives you the total. And this is common across every single income statement, balance sheet. All financial statements are going to have something like this. It's the standard. Companies often will have, if you look on Edgar, on SEC, you will see that companies will have the same setup like this. Especially Amazon or any large corporation will have the same format when it comes to how they report the financial statements, to make it so people like you and me and other financial analysts can quickly look at a company's balance sheet or income statement and understand what's going on, that things are not different, these rows are not different year after year, and it becomes really complicated. They're actually, by law, have to keep things in a good format that is understandable year over year. So their current assets, and they tell you the total current assets, and then here's your long-term, and here's your total assets. So 2016 to 2017, assets have increased fairly well, which is really good to see, right? Assets are good for investments, current liabilities or sales growth and such like that. So long-term assets right here, right? Property, plant, and equipment, goodwill. Goodwill is kind of when they buy something and the price. Yeah, so goodwill is a little complicated, but there it is. This is a long-term asset. Current liabilities, liabilities due less than 1 year. Here you are. You have your total current liability, right? Year over year, it has increased. But what about your total assets, right? Your total current assets year over year has also increased. If we compare total current assets, 2016 is about 46 million. Total current liabilities about 44 million. It's good to see because assets are greater than liabilities, which means it's healthy. If a company needs to cover their current liabilities with cash or something like that and other inventory, they'll be able to. So it's good to see this is healthy. Once again, they break down long-term liability, but they don't tell you all of it. So what you could do is, since they don't tell you the total, you can go here at the bottom, it says total liabilities and stockholder equity. If you know what stockholder equity is, which is about 19 million, the rest of the total liability stockholder equity is 83. So you can quickly find out what's your total liability, which will be about, let's round this to 20, it's going to be about $62 million of long-term debt. And 62 million, about 20 right here. So it's about $20 million in long-term debt and $45 million in 2017 and about $20 million in 2016, which is okay because their long-term assets is greater than their long-term liabilities. Here's your retained earning, a retained earning line. This is, of course, like we talked about, how much the company has been able to keep net income since inception, and of course you see from 5 to 8.6 year-over-year growth is good because it shows the company has made positive net income and didn't lose the money after distributions and such, and such as dividends, preferred dividends and stuff like that, and minority interest. So this is usually the process that I go through when I'm looking at a balance sheet. But before you even want to consider a balance sheet, it's best to consider, do you even want to invest in the company, and is the company what is the company doing to help the world become a better place? And that's it, guys, ladies and gentlemen. Thank you so much for joining me today. I appreciate you being here. Here is my channel. I'll be posting this video soon. I just posted a video concerning the this D variance and how it's going to impact the market. Is the market going to crash? That was a great video. If you have the time, check it out. I've also posted a video on Red Rock Resorts and big digital assets, and is hire car a scam? Also, when you get a chance, go check that out. And thank you so much for joining me today. I appreciate your time. Make sure you subscribe, you comment, and hit that notification bell. We'll be back probably tomorrow. I'm going to post another video. Thank you so much. Bye.